We will get more earnings from Walmart, Macy's, and Gap tomorrow. Here to discuss the retail space is CNBC contributor Stephanie Link of Hightower Advisors. I mean, first and foremost, when you look up relief rally in the dictionary, it says see target, because that's what this appears to be today after the stock's gotten, obviously had gone through a tough stretch. I talked to you about that earlier. I didn't talk to you about TJX. Let's hit that one first.
Yeah.
What do you make of that? Because that stock is not acting like Target.
No, and it's exact opposite, Scott. Whereas Target has such low expectations, a low bar to kind of jump over. TJ, really high bar. It was up 15% into the print. It trades at 24 times. Out of all the off-pricers, it's the most expensive. And by the way, I think it should be the most expensive because the market share that it has and that it's taking. I thought the quarter was just fine. It's just a relative to expectations thing. I mean, you had a 6% comp versus 4.9, which is what it was expected. But in August, when they first issued guidance for comps, it was 3 to 4%. So they saw an acceleration. And then, of course, the same thing with what we saw with Target on the margin side and the profitability side. Gross margins were much better than expected, up 200 basis points for TJ. Operating margins beat by 50 basis points nicely. Again, merchandise margins, lower freight costs. That's going to be a theme across the board. We talked about that earlier today. It's the guide. They needed to just crush the guide, and they didn't. They did raise it for fiscal 24, but the fourth quarter is a little messy with expense timing. So I get why it's down. This company is a wonderful company. They are always conservative. It always trades crappy around the quarter, and that's the time when you want to buy it.
Yeah. Are you buying more?
Yeah, I will. I'm going to let the dust settle for a couple of days. Let's get through earnings. But this one in Target, I'll be buying more Target at 13 times.
Okay, you set me up for that. I had to ask you that. You walked right into it. Cisco in overtime. You own that too.
Yeah, so I think the quarter is going to be in line. I think expectations are fairly low. There are two things that we're keeping an eye on. Product orders. And that's going to be down 18%, following down 14% last quarter. If it's anything worse than down 18%, stock's not going to like it. Investors aren't going to like it. Stock's going to go down. Backlog drawdown. That's the second thing that we're looking for. They drew down $3.7 billion last quarter, $2.7 billion this quarter is expected. Again, anything kind of that deviates from that number probably will affect the stock price. But really, at the end of the day, Scott, this is why I own it is because of Splunk. I think that story is really exciting. It adds to the growth rate. It's accretive. It also increases their software and security revenue and their recurring revenue. That's why I like Cisco at 13 times forward.
I thought you could say you owned it because of Chuck Robbins, of course.
I do like Chuck. I do like Chuck. I'm looking forward to hearing him later on CNBC on Jim's show.
Wow, I was going to tease it. Now I don't even have to. You just did, but that's how you roll. You don't have to. That's how you roll. All right, you added to you added to Bank of America too. That's an interesting one, given just what's going on in the market, and you know what hasn't gone on in the market. And I'm referring to the fact that bank stocks just really haven't done much.
I know, they haven't. And this thing is still down 10%. It's been a laggard, and it has been a laggard because of interest rates and their bond book and the concerns there. I think if rates have peaked, which I think they have, the stock should settle in. It's not going to act as crazy as some of the regional banks, because there's a lot of leverage there. But I do think that it's cheap at 0.9 times book value, doing a great job on cost cuts. I like the diversified brand. So it really is all about rates and the valuation.
Is it time to get more heavy in these other areas? That's a natural segue from you buying more BAC and some of the other moves you've made. You haven't been afraid to approach the consumer a little bit more with McDonald's recently, for example. What about that question?
Yeah, I do think so, but I don't think it's all or nothing, Scott. I do, as you know, I've been adding to some of the mega cap techs because Meta is still cheap and Alphabet is certainly very cheap, and they both had really good earnings. Amazon's not cheap, but relative to its historical average, it is, and I like what they're doing on the margin front in retail. That said, I think there's way better value in industrials. I just bought Quanta Services, and I like that one a lot. Parker Hannifin blew it away. I think that's getting a re-rating as well. I'm looking at some of the material names because I actually don't own any, but I'm looking at a Freeport again. It's up about 10% in the last couple of days, so we'll wait for that to settle. But I do think there's going to be a catch-up. There's a ton of cash on the sidelines, and I think it's all going to go into the market as a whole, not just one small group, one small sector.
Wow, so you're that bullish?
Yeah. Yeah, I am. I mean, I've been buying. I've been buying since middle of September when, things were really getting hit. And I think there's a year-end rally to be had. Seasonality, we know, is in our favor. A lot of negative sentiment as well. You know what I feel about in terms of inflation, making progress there. I feel good about the consumer. It's not perfect by any means, but I don't think the consumer is dying. I just look at, like you mentioned, McDonald's, look at Starbucks, look at Lulu, look at American Express. There are a lot of good numbers coming out. So I think you just got to pick your spots. And I think it's kind of a stock picker's environment.
All right. We'll leave it there. Steph, I appreciate it very much.